Standard Life buying Aberdeen, Janus, and Henderson. The asset management industry is in turmoil. Why? Beat Wittmann, we've seen a lot of mergers in the asset management industry in recent months. Aberdeen and Standard Life, Pioneer and Amundi, or Henderson and Janus. Why?
Well, this industry has been in consolidation modus for a while because of risk aversion of investors, low interest rate environment, and of course huge overcapacity in Europe, and new regulatory changes which are forcing consolidation.
What's changed to make all this happen now?
Well, I mean, some companies came to the end of their resources and abilities, so size and also diversification of offering and the ability to distribute product across borders, puts pressure on what we call a competitive position, and so we have seen quite a bit of defensive mergers recently.
Is technology playing a role in this process?
I think technology is probably the single biggest factor in changing and transforming the financial industry at large, and also the asset management industry, because the traditional cost structures are not sustainable anymore. And then, quite frankly, 3/4 of all functions in the financial industry you can parameterize and put on a technology platform.
There's been a kind of almost a holy war going on inside the asset management industry for the last few years, and that's of active managers versus passive ones. Who's going to win?
Well, I think in relative terms, the passive industry will take big market share, especially Europe, which is still lagging the US. And the active managers have absolutely a future, but they have to be really active, not index hugging, and they have to charge competitive fees, and they have to deliver superior returns to indices and the relevant peers.
We've also seen, and speaking of technology, the first Robo Advisors emerging in the asset management industry. Do you see a future where we won't really need a portfolio manager anymore?
I think we need human beings when it comes to develop complex solutions and deliver complex advice. Same is true for investment decisions, but a large part of the value chain, no matter whether it's corporate management, compliance, risk reporting, finance, or also in many ways client interaction or the implementation of investment decisions, will be taken up by technology.
We've talked about a lot of changes that are going on in the industry, from technology to mergers, consolidation. If I ask you to look 5 years into the future, what sort of picture would you paint of this industry?
I think the big winners in this industry will be the ones which on one side have the critical size and offer passively managed products and services. Groups like Vanguard, where also incentives are aligned with all stakeholders, or then active passive mixed entities like BlackRock. And at the very other end of the spectrum, you will have active managers, either single boutiques in inefficient corners of the capital market, or of course multi-boutique setups. I think the big losers will be all the index hugging, captive distribution asset managers, and they typically belong as a business entity to a universal bank.
Very clear views from Beat Wittmann. Thank you very much for being with us. And that was FinNews TV in cooperation with Ducascapi TV. Please join us next time.